Next, we have on lineup Ms. Dr. V.Ananth Nageswaran from Singapore coming to you to give some credibility and the profile of this eminent person. He is a member, Economic Advisor Council to the Prime Minister of India, Government of India, and he is going to talk to us about Indian economy, the way forward. And the topic is really interesting. What do we say normally? The glass is either half full or half empty, depending on the way we look at it. But here he is coming and talking about a glass more than half full. Over to you, Dr. Anantha Nageswaran, please.
Good morning, ladies and gentlemen. It's really indeed an honor, pleasure, and privilege to be able to address you as part of the 11th Knowledge Summit of IFA Galaxy in 2021. The title of my talk is Glass More Than Half Full, the Cyclical and Long-Term Growth Outlook for India. Seldom have I caught myself being more optimistic. In general, I am paranoid about risks because in general, when returns are aplenty, there are a lot of people who can take advantage of that. But it is a risk that gets usually neglected simply because nobody wants to face up to the potential downside. And I have always taken it upon myself to sound the odd man out, pointing out the potential downside and the risks, etc. But however, there are times when I think one has to point out that the opportunities are far in excess of the potential landmines or pitfalls. And India faces one such situation. In fact, this decade of 2021 to 2030, if it is the third decade of the new millennium, if it is handled well, could very well turn out to be even better than the first decade of the new millennium was. And that is why the title of the speech is Glass More Than Half Full. So just a background, India's nominal GDP at the end of March 2020 is about little over 200 lakh crores or 200 trillion rupees. And nominal real GDP was around 146 trillion rupees. Of course, for 2021, which we have barely a month to go, it's going to be around 195, 196, 197 trillion rupees on nominal GDP and 135 trillion rupees for real GDP. Of course, on Friday, the February 26th, the Government of India did release its third quarter fiscal GDP number and in the process updated the GDP forecast for 2021. And that is going to be an 8% contraction in terms of real GDP. But we are in the ballpark. So we're talking about starting from little under 200 trillion rupees of GDP, which is roughly around 2.7, 2.8 trillion dollars in the current exchange rate. And that is where we are. And certainly this contraction of 7.5 or 8% for the current year ending in March 21 is nothing but a culmination of steadily declining real GDP growth, which started sometime in 2000 and year ending 2017-18. And from there, we came down to year ending 2018. And then year ending March 2020, real GDP was barely 4%. And now it's going to be minus 8%. So this has been a steady decline over the last several years. And hopefully this contraction turns out to be the real bottom. And I believe it will be the real bottom because after all, in the third quarter, the sequential momentum of GDP has picked up quite strongly from the second quarter for the fiscal March 2021. My apologies for this slide. There are too many words here. And this is taken from an article written by Professor T.T. Ram Mohan, who's one of the more disinterested observers you can find on the Indian macroeconomic scene. And he clearly points out that the non-financial corporate sector is quite resilient. I will just point out a few specific aspects on this slide. Basically, moratorium loans accounted for only 31% of all loans in phase 1 and 18% of phase 2 of the lockdown. So more firms should have opted for loan moratorium from the banks, but they didn't. So probably the gloom was far more exaggerated than the reality turned out to be. Banks also expect restructured loans to be around 2 to 3% of their loan book, well below the 5 to 6% that they had expected when the moratorium schemes were announced. Moving on to the third paragraph, in general, it is very clear that some of the better rated firms are able to access funds at lower rates through the commercial paper market, and they're using those low cost funding to service their existing bank loans, and that could explain why far fewer percentage of firms opted for a loan moratorium. In general, I think CRISIL has anticipated that non-performing loans would turn out to be around 10.5 to 11.5% rather than the 14 to 15%, which of course RBI does expect in an extreme stress test scenario. So by and large, some of the biggest fears we had in the early stage of the pandemic and the lockdown in April to June 2020 period, they have not thankfully borne out, and we are seemingly on track for a much better corporate sector. And one more confirmation, and again, this comes from another article in Bloomberg that appeared in December 2020. CRISIL says at least 99% of the corporates that CRISIL rates don't aim to seek restructure. And at least two-thirds of those entities were eligible. So that's a very, very minuscule portion is going to opt for restructuring. And small businesses too, obviously, they are slightly more than the large corporates looking for restructuring. But even then, they were also fewer than anticipated in terms of loans being restructured. And Credit Suisse, tracking the micro data, points out that firms with interest cover ratio of less than 1 have dropped sharply to about 35%, the lowest in the past 5 years. Also, the aggregate second quarter EBITDA was up 54% quarter on quarter, 8% year on year. And of course, the share of debt held by companies with interest cover ratio less than 1 dropped even below the pre-COVID levels. In fact, the share of debt held by loss-making companies in the country was down to 23%, also one of the lowest percentages in recent years. Coming from the corporate sector to the MSME sector, the Civil Trans SIDBI MSME Pulse showed that the COVID situation may not have impacted all sectors equally, but there is a vast majority of MSMEs across sectors that are structurally strong, and they are better placed to handle the economic challenges going forward. So this kind of provides you the backdrop in the COVID year 2020, with the economy contracting by around 24% year on year in the first quarter of the current financial year, to a situation where now we are anticipating somewhere between 10 to 13% real GDP rebound in the next financial year 21-22, and nominal GDP could go as far as even 20%. But of course, let's not forget that the Indian budget has only assumed around 14% nominal GDP growth and around 10% real GDP growth, and that augurs very well, but more on that later. In the meantime, it is the reason why we should be able to see the recent third quarter GDP growth numbers in perspective is that momentum has continued well into January and February. If you look at the Credit Suisse India market strategy, 19 February 2021, it's a typo there, my apologies, it should be 19 February 2021. They clearly say that the activity indicators point to the recovery continuing. E-way bill generation is up 10 to 12% year on year compared to the pre-COVID figures. Inventory building continues to happen. Basically, after a sustained period above the normal trend line of destocking, secondary sales as a percentage of primary sales dropped in January 2021, and basically channel inventory rebuilding is happening. Rail freight is up 10% year on year after 13% in December. And then you also, of course, have other factors like fleet share shifting from road to rail, etc. But the trends in general are synchronized with the bottom-up company commentary that Credit Suisse was expecting based on third quarter call. So there is a quite a good synergy or synchrony or consistency between what they are hearing from bottom-up corporate commentary as well as what the macro data are indicating. And that is basically a good situation to go into 21-22. So it is not just the rebound from the first quarter contraction, but it is now a sustained rebound. So let's look at the next 5 years of forecast that the IMF has come up with. IMF predicts that India's nominal GDP will grow up to about $4 trillion by the end of March 2026. And in Indian rupee terms, the GDP would be around 330 trillion from around 200 trillion right now. But mind you, 330 trillion rupees or 330 lakh crores translating into $4 trillion means they are expecting that the rupee will weaken somewhere to around 83 from the current 72, 73 in the next 4 to 5 years. This is in line with the normal depreciation of the rupee. On an average, we have seen around 3 to 4%. But it is quite possible that India experiences a rupee appreciation in the next 5 years, like we did between 2003 and 8. And that obviously will pose macroeconomic challenges as well as challenges for the corporate sector in terms of becoming more efficient. And more importantly, we shouldn't be repeating the mistakes we made between 2003 and 8, putting money in the wrong sectors, over investing in quicker return generating, but eventually problematic sectors, etc. So if we have to basically show that the third decade is going to be a superior one to the first decade, when India experienced 5 consecutive years of 9% GDP growth, we have to be very sure that we don't repeat those mistakes. And that is what we will be coming to later. And IMF said in its Article 4 assessment of the Indian economy, published in December 2019, the new one, which should have been coming out in December 2020, is delayed, possibly due to COVID related disruptions. In its more recent one, which was about a year old, IMF said India's potential growth is around 7%, but this potential growth could raise to 8% if there was fiscal consolidation and if there were structural reforms. And to its credit, the government has indeed done both. Some of you might think that the budget for 21-22 is not exactly a fiscally prudent one, but that is where there's a misconception. It actually budgets revenues conservatively and expenditure moderately so that on balance, there is room for upside surprise, positive surprise, i.e., the fiscal deficit could be lower than projected rather than higher than projected. So, in that sense, it is a conservative budget. It is not an expansionary, but it is a prudent budget because it budgets for very, very modest revenue, GDP growth, both real and nominal. It budgets for very realistic tax revenue growth, and it has taken a realistic estimate for public sector share sale or RBI dividends, public sector bank dividends, etc. If you look at many of these indicators, the assumptions that the budget has made are quite realistic and conservative. So the room for upside surprise, positive surprise on the fiscal deficit is much higher than the room for disappointment. So in that sense, one of the boxes is ticked that there is a tendency towards fiscal realism and fiscal prudence. Second, structural reforms, notwithstanding the GST introduction, IBC introduction, the Real Estate Regulation Act, etc. The reforms announced both in the various Atmanirbhar Bharat packages of 2020 and the budget of 21-22 announced on February 1st, there is clearly a willingness to bite the bullet or to sort of take the plunge, notwithstanding the expected resistance from known quarters, into areas which have not been dealt with before, whether it is privatization, whether it is exiting from non-strategic sectors, etc., or asset monetization or labor reform. The government is willing to push into areas which have proven to be difficult in the past because it believes that it has the political goodwill which it can sort of monetize right now in favor of structural reforms. And therefore, to that extent, potential growth will be heading towards 8% in the second half of this decade, and that augurs well for sustained GDP growth. If only India can sustain 7 to 8% real GDP growth for a decade, the transformation in the country will be remarkable and will be visible to almost everybody as we head towards 2030. So, but right now, it is not that feeling. Everybody thinks that India is sort of stuck in a low growth environment, and that is a sort of the widespread public perception. And some of the popular commentary kind of points out this chart that if you look at the dollar GDP per capita, India's growth in the second decade was just about 3%. In the first decade was around 12% in dollar terms. We seem to have fallen a long way in the second decade compared to others. Is that really true? That is where the devil is in the detail. So the answer is it depends on what you wish to establish. If only India excludes the first 3 years of the last decade, especially 2012 and 13, when the rupee collapsed against the US dollar, going from 45 to 69 in the course of 2012 and 13, you exclude that, India's performance indeed still shows a meaningful drop, 12% average growth in dollar terms, down to 6% instead of 3%. And India hasn't done badly compared to others, excepting countries like Bangladesh, which actually has bettered its first decade performance. But everybody else has had a second decade which was somewhat lesser in growth average numbers than the first decade. But India is certainly not an outlier in terms of the deterioration. So clearly, what we wish to establish is an important criterion in picking the numbers that one wants to present. And in fact, if you look at the period between 2014 and 20, growth in GDP per capita, and you compare it not just with Asia, but with other emerging market countries outside of Asia, Brazil, Mexico, Turkey, Malaysia, South Africa, etc., India actually turns out to be the star performer rather than a laggard. So again, what is the not only the period but also the cross section that we want to use for comparison purposes is a function of the message that we want to convey to the outside world. So clearly, India hasn't been such a outlier laggard as the perception appears there out to be. The second decade, India really lost out in terms of growth. That depends on which currency we measure, which time period we use, and which cross section of countries we want to use as our reference universe. And the reason why there's such a big contrast between the two decades is that in the first decade, 2000 to 2010 of the new millennium, so out of 10 years, 7 years Indian rupee appreciated against the US dollar. And that is what you see with the bars below zero in the first decade. In the second decade, exactly the opposite. Only 1 out of 10 years the rupee appreciated, that is 2017-18, whereas every year the rupee depreciated against the dollar. So in a way, the rupee was actually adjusting for the first decade appreciation. So clearly, there is a sort of a mean reversion happening there, not so much in terms of growth, but in terms of the exchange rate. But mind you, let me also point out that in 2017-18, the rupee appreciated, and that was the period when the Federal Reserve, under a new chairperson, was actually trying to increase interest rates in the US. Normally, when interest rates in the US go up, everything else being equal, the dollar should be strengthening. But in that year, the rupee was strengthening against the dollar. And that tells us that India's monetary policy was far too restrictive in the face of a restrictive or normalizing US monetary policy. That tells you that monetary policy in India also has played a very big role in the economic slowdown that we witnessed from 2017 onwards up to 2020. So the performance of the rupee has a lot to do with so-called mediocre growth performance of India in the second decade. So just to give you the contrast, the why India was not such an outlier, look at again among the BRICS countries, Brazil was touted as another star along with India in the first decade with its commodity exports. Brazil had 5 consecutive years of real appreciation against the dollar. That's what the red arrow points out. Again, that was a boom period for the world economy. But look at the second decade. The Brazilian real depreciated every year except in 2016. In fact, in 2015, the real weakened by almost 50%. And that is why I think, many of these countries are considered to be growth laggards in the second decade. That said, is the rupee poised for appreciation or depreciation in this decade? If you look at one of the workhorses of the exchange rate modeling, the relative purchasing power parity part, if you look at it, the rupee actually currently is overvalued. around 73, it should be close to around 90 rather than 73. So in that sense, one can argue that the rupee is already overvalued. And if you look at the RBI's measures of real effective exchange rates, that is what you also see there, that the rupee has appreciated in real terms. So here I am saying, therefore, the rupee may again appreciate this decade. So is the rupee going to get overvalued? The answer is yes, there is a very high chance the rupee gets overvalued because the RBI cannot continue with its FX reserve accumulation policy, which it has followed for the last 12 to 15 months. That will create more side effects. So in effect, the Reserve Bank of India has to choose between two evils, whether to let the rupee appreciate and face the consequences for exporters, or keep intervening and create domestic liquidity, which goes into all kinds of wrong sectors, creating asset bubbles, overinvestment, malinvestment, and once again setting the stage for another spell of non-performing loans in the next decade or the second half of this decade, etc. So the choice is between figuring out which one of this is a more manageable situation. And I would argue that a slightly gradually appreciating rupee will be a better incentive for productivity in the Indian corporate sector and the business sector in general, rather than keeping the rupee suppressed and creating too much of liquidity, resulting in all kinds of excess investment, excess credit growth, current account deficit, etc. So, at the same time, what can the government do to make sure that we handle the rupee appreciation that is possible in a sensible way? First thing to start would be to have good quality macroeconomic data. If you look at this slide, you can see this is from the RBI Handbook of Statistics on the Indian Economy. It's a snapshot. You can look at it yourself on the RBI website. This simply presents the consumer price index data. We have multiple base years, as every country has. The base year gets revised every 5 years or so. But whenever the base year is revised, normal statistical agencies in every other country, especially in the developed world, they go back and revise the data for the previous year so that for the new base year, we have the historical time series recreated. But in India, we don't do that, so that the historical time series of consumer price index is no longer comparable. There is no continuity in the data. And inflation, growth, current account deficit, all these things are very basic building blocks of macroeconomics. And without having a long-term time series, it is difficult to model, it is difficult to create econometric models that one can rely on, etc. So having good quality macroeconomic data with a reliable long-term time series is a very basic building block of sound public policy, and we need to invest in that in the coming years. But all said and done, does India have the chance to overtake China? Because there have been commentary in the last 2 to 3 months saying that one has given up hope on India ever overtaking China, etc. And of course, Mr. Manish Sabharwal of Team Lease wrote something of a rejoinder to that pessimism, and I had written something on this as well in December 2020. So how far China is ahead? Now, if you look at this chart, you would think China is way ahead of India. The numbers were almost identical in 1990, and over 30 years, China's GDP has grown to be 5 times India's GDP in dollar terms. Clearly, the renminbi's performance against the dollar also has been far superior. That also has helped. So in dollar terms, China is around 13, 14 trillion dollars. India is barely around 3 trillion. That's about 4 to 5 times. So is all hope for India lost in that sense? Well, if you look at this chart, you will realize that just as China's GDP was so wide in terms of India's GDP, China's GDP in turn is far lower compared to the growth in debt in China. In other words, China has become more indebted before it became prosperous. You look at China's overall debt with about $30 trillion and the GDP of about 12 to 13 trillion dollars. You're talking about national debt, public and private sector, corporates, households, etc., totaling 250% of GDP. Developed world has similar debt percentages, but the point is they are developed. Their per capita incomes are above 40,000 to 60,000 US dollars. China's per capita income is barely around $8,000 to $10,000. And that is why China has more debt before it became prosperous, whereas the developed world now has debt after it became prosperous. That's a very big difference. So if you scale both India's and China's debt, GDP by debt, you can see that India's GDP divided by total debt, the orange line, is far better than China, which is close to around 30 to 40% only. In other words, lot of China's GDP growth, and if I want to take you back to the growth chart again. But much of China's GDP growth started from 2005 onwards in the last 15 years. That is the period when its GDP took off. That also happens to be the period when its debt took off as well. So, in other words, even though China's economic reforms began in 1979, and for the first quarter century, it had a very good set of economic reforms and growth, in the last 15 years, bulk of the growth has been driven by debt accumulation. So, to that extent, India should feel that it has got a better potential to catch up than it was in the last 40 years. And that is what this slide shows you, where India's GDP scaled by debt is much higher than China's, the blue line. So, one of the building blocks of this is that India's credit boom, which was evident in the first decade, growing from 25% of GDP credit to the non-financial sector from banks, it doubled to more than 55%, the ascending red line. And then for the last decade, from 2010 onwards, it has stayed flat at around 55% of GDP, thanks to the excessive growth in the first decade. Then there is a plateauing out, there is deleveraging, banks are unwilling to lend, the borrowers are unwilling to borrow, they are deleveraging, etc. So this happens in most emerging countries. A credit boom gone sour usually leads to a period of consolidation. And I think we have put that consolidation period behind us right now. That is one good factor. That is why you saw in all the numbers of corporate improving balance sheets, interest cover ratios improving, debt held by loss-making companies going down, etc. You look at the FDI flows. This is net FDI. That is FDI coming into India minus FDI going out of India by Indians investing abroad as a percentage of Indian GDP. Only once in the past, it exceeded 1.5% in 2008 and 9. But if you look at the last 6 years, every single year, it has exceeded 1.5% of GDP, excepting in 2 years. So 4 out of 6 years, India's net FDI ratio has exceeded 1.5% of GDP. In the current financial year, we have only data for the first 2 quarters, and that's why I couldn't have a number for 2020-21. But we are on track to exceed 1.5% of GDP in the current financial year as well. So FDI flows also augur well for the country. And therefore, this gap that has opened up in the last 2 years, that the savings rate has bottomed out and slightly improving, the blue line, whereas the gross fixed capital formation, real investment spending in the economy, which is kind of flatlining there around 29%, I think that is now that gap is going to close, because savings rate, once it picks up, it automatically slowly, and with the corporate sector deleveraging behind us, gross fixed capital formation will also be picking up soon in the coming years. And one of the reasons why we should be optimistic about capital looking for opportunities in countries like India is that the United States and the UK are looking to emulate what they did in the 1970s. In the 70s, they basically brought down their debt to GDP ratios by unleashing inflation. US debt to GDP came down from 55% down to 32%, mainly because of double-digit inflation in the 1970s. And you look at the UK, and because you can see in the next slide here, inflation was around 12.5% and 15%, rising throughout the 70s in the US. The same thing happened in the UK, even more dramatically. The debt to GDP ratio came down from 100% down to 40%, and UK's inflation performance was worse than America, with inflation rates rising to more than 20% in the 1970s. So effectively, what the developed world is trying, without stating in so many words, is to reduce their debt levels through higher nominal GDP growth and also creating higher nominal tax inflows, etc., so that the overall debt to GDP ratio came down, which is what happened in the UPA years as well in India. Despite growth rates being low, India and budget deficits being very high, debt to GDP ratio came down because India's nominal GDP growth between 2010 and 2013 was much higher because of extremely high inflation rate. And that's exactly what happened in the US and the UK in the 70s as well. And that is what they are hoping to replicate. Therefore, real returns in the developed world are going to be very, very scarce. They'll be negative. I don't think I personally am worried that I'm not worried that the US bond yields will keep rising, because if it keeps rising, the Western economies are more or less finished. And if you go back to 2018, when the Federal Reserve was trying to normalize its interest rates, the Federal Reserve could not go beyond 2.5%. The economy was already beginning to appear very shaky, and Mr. Powell had to do a 180-degree turn in 2019 and start easing monetary policy. So I think the bond yield scare of the last few weeks is a scare. And the developed country central banks, including the Federal Reserve, have no option but to intervene massively. And that will complete the process of socializing the financial markets in the developed world. And that is an irony. 30 years after the collapse of communism, the Western financial market, which was one of the hallmarks of capitalism, would have been completely nationalized. Whether it is the bond market or the stock market, it is the Federal Reserve money that is basically dominating everything. So, but that's a separate topic. What it means for us is that real returns in the developed world will be so low that much of the money will keep looking for opportunities in emerging markets, as it was in the first decade when Mr. Greenspan brought down the Fed funds rate down to 1%. That is going to repeat itself in a much more dramatic fashion in this decade. You can see that in this chart here. Look at the central bank balance sheets of Federal Reserve, European Central Bank, Bank of Japan. If anything, People's Bank of China looks far more sober and prudent. If you look at the central bank balance sheet as a percentage of GDP, the Fed is 33.5%, ECB is 55%, Bank of Japan is 127%, and China is 35%. So clearly, liquidity flows have to find a place somewhere, and emerging markets and commodities will be areas that they will be looking to invest in. So as you can see here, it's already evident. This year, FII inflows into Indian equity markets, more than $33 billion, is the highest in 30 years. And this pattern is going to repeat over the years, including in the FDI space as well. So if you look at this slide, why this money looking for opportunity in the developing world would zero in on India is many other key emerging market nations are actually moving in the wrong direction. This slide talks about on what's happening in Mexico and what's happening in Brazil, and investors are not too happy with these developments. There is a tendency to sort of prioritize the state electricity company, and there is the government has scrapped a partially built airport, cancelled electricity auctions, re-return pipeline contracts, etc., etc., and they have plans to ban subcontracting of jobs, etc. India is moving to actually reform its labor code, allowing for more contract labor, etc. So clearly, this is Mexico. The second paragraph talks about Brazil, with the president, firing the chief executive of the largest public sector company there, Petrobras, etc. So clearly, there are not too many emerging market countries that look alluring to investors. Whereas India, with its COVID management, because if you look at the Bloomberg, there's an article saying how India's COVID vaccine diplomacy is actually currently outpacing China's. And India also figures in the top 20 countries that have got a better measure of their COVID situation. Touch wood, I hope it stays that way. So if you take all this together, there is political stability, and the government is focusing on fiscal prudence and is not shy of pursuing structural reforms. So these are in contrast to what you see in this slide. And that is the reason why the money looking for returns from the developed world will cannot find a much better sanctuary than India in the coming decade. And so, to sort of capture once again what I was saying, in the new millennium, in 2000 onwards, growth rates between developed markets and emerging markets diverged. Emerging market growth rates were faster. GDP converged, but growth rates diverged. That's a good thing. In the second decade, unfortunately, growth rates converged. Emerging market growth rates declined. GDP therefore diverged. Not a good thing. In the third decade, the growth rates would diverge again and GDP would converge. That is going to be a good thing. So it's convergence, divergence, and reconvergence. But this time, the big difference is, unlike in the first decade, not too many emerging economies are in the sweet spot. India is an exception. So what we should do, of course, you can never be complacent because of our own history. We have always blown up periods of high growth and they have fizzled out or dissipated after 3 years or 5 years. So what should we do to cement the sweet spot? The government should chart out its own path of economic development, and that is what it is doing with its PLI schemes, Atmanirbhar Bharat, with import duty, at the same time expecting manufacturing to happen in India with clearly production-linked incentives. That's a good thing. India liberalized trade and finance before it liberalized the real economy. China did the opposite. China liberalized the real economy. Trade liberalization came in 2001. Financial liberalization is happening now. So India, in a way, is applying the corrective action and just about the right time because China is vacating manufacturing and India is sending signals that it is ready to step into China's shoes. Of course, inflation targeting should be broadened into targeting overheating. We should pay attention to liquidity, asset price bubbles as well, not just CPI inflation rate, because the flexible inflation targeting is too narrow for a country like India. There are other indicators of overheating that we need to keep in focus, especially as we go towards 22, 23 and further. India should divest from LIC. I don't mean the Life Insurance Corporation. Indian government should divest from license, inspection and compliance Raj. And it is not just the union government, state and the local governments must also do this extremely enthusiastically and strongly and in a sustained manner. India should get out of the LIC Raj, divest from the LIC Raj, and that is the key cornerstone of growth this decade. Letting go and regulation by exception. Then governance in public sector banking, we should bring it on level playing field. The PJ Nayak committee recommendations of 2015 continue to remain a very good template for us to follow, and that is the reform blueprint for public sector bank governance that needs to be implemented. Data quality, we discussed that earlier. Timely, accurate, and high quality data are needed for sound policy making based on evidence rather than based on ideology. And of course, if you want to encourage gross fixed capital formation, India's current capital gains tax regime favors more of listed investments, listed financial market investments, but it should become more aligned in terms of risk and reward. So the capital gains taxation is all over the place. That needs to be fixed as well. But overall, India is on the right track with fiscal prudence, with the right incentive for domestic manufacturing, with structural reforms. Other emerging markets are going in the wrong direction. Developed country is going to bring down their real returns because they need to bring down their debt to GDP ratios. And India is therefore, in my opinion, poised to repeat its high growth performance of the first decade, and hopefully this time it can sustain it for a much longer period than we did in 2003 and 2008. And I hope therefore you all will have a rewarding time not only in 2021 but beyond as well. I hope you found it useful. Thank you very much, ladies and gentlemen. Wish you all a very healthy and profitable 2021.
That was really interesting. What an optimistic view. All of us can really cherish, and we are so relieved to know the post-COVID transformation that India could expect. In fact, this is really very, very reassuring, sir. Thank you so much, Dr. Anantha Nageswaran, for that wonderful presentation, and thanks for taking time out of your busy schedule and agreeing to join with us during this momentous occasion. Thank you so much, sir.